Hi everyone, this is Kang from the StoneX Agricultural Commodities team here in Singapore. Today, I'll run you through what happened in the vegetable oils market last week, focusing mainly on palm oil and soybean oil. Last week was not purely driven by fundamentals at the start. The key trigger was macro, especially crude oil. Once headlines came out around a possible US-Iran deal and reopening of the Strait of Hormuz, the crude oil sold off sharply and that dragged the entire vegetable oil complex lower. Palm oil reacted the most to that move, particularly into the end of the week. Palm oil prices held relatively steady early in the week but weakened sharply into Friday. The August contract failed to sustain above the 4,590 to 4,600 area and eventually closed lower for the week. What stood out was the flow. Volume increased while open interest declined, which clearly shows this was long liquidation rather than fresh shorts entering the market. So the sell-off was driven by position unwinding and not a shift into a new bearish trend. Midweek, the MPOB report came in and confirmed the softer tone. Stocks rose to above 2.4 million metric tons, mainly due to a sharp drop in exports and weaker domestic consumption. Even though production declined, the fall in demand was larger, resulting in a build in inventories. The takeaway is quite straightforward. Demand underperformed, and that is what is weighing on the market in the near term. On production, June is seeing some recovery but not as strong as earlier expectations. The first 10 days showed stronger output due to more harvesting days, but as the month progresses, the pace is expected to slow. Overall, June production is likely to come in only slightly higher month on month. Looking at the broader trend, Malaysia's production this year has been quite front-loaded. Output in the first 5 months was relatively strong, but by May, year-on-year production dropped more than 14%, which suggests that the underlying momentum is slowing. Even with more harvesting days expected in July, recovery is likely to be moderate rather than strong, potentially around low double-digit growth month on month. On the demand side, buying remains cautious. India continues to be a key swing market. Palm imports did recover slightly in May, but volumes are still below typical levels, while soybean oil imports increased sharply. This clearly shows that demand is still there, but it is highly sensitive to pricing. When palm loses its discount, buyers switch quickly into soybean oil. So maintaining a competitive spread remains critical for palm demand. Beyond the near-term weakness, the bigger structural story is still weather. El Niño conditions are already developing, and the probability of a strong event has increased significantly over the past month. Historically, strong El Niño events lead to prolonged dry conditions across Southeast Asia, which disrupt palm oil production cycles, particularly flowering and fruiting. The key point is the timing. The impact on yields is usually lagged, meaning effects from a potential strong El Niño in the second half of 2026 are more likely to hit production in 2027. Under such a scenario, global palm oil supply growth could shift into contraction, potentially declining by a few percentage points year on year. This is where the real upside risk comes from a longer term perspective. Even historically, price reactions to El Niño can be quite volatile, with periods of initial weakness followed by stronger upside moves once supply concerns become more visible. Now shifting to soybean oil, the structure is a little different. Despite the sharp drop in crude and diesel prices, soybean oil held relatively well and even recovered from session lows. This already tells you that the market is being supported by something stronger than just macro. The key driver is still biofuel demand. Even at current price levels, soybean oil remains profitable for biodiesel and renewable diesel producers, so demand remains intact. Most importantly, the market is still behind on meeting blending mandates. That means additional feedstock is still required, which keeps underlying demand strong. So even when energy prices fall, soybean oil does not necessarily follow because its demand is policy driven, not purely price driven. Stocks have also been tightening. Recent data showed a significant drawdown in soybean oil inventories, which signals strong consumption. This is happening despite higher crush levels, meaning demand is still outpacing supply in the short term. The forward structure reflects this as well, with strong nearby premiums indicating tight immediate availability. So compared to palm oil, soybean oil is operating in a much tighter near-term balance. Globally, soybean supply is still comfortable. South America continues to have good availability, and weather conditions in Argentina are expected to improve, which will support the next crop cycle. At the same time, longer-term policy changes such as reductions in export taxes and duties are likely to support production and exports. So globally, there is no shortage of soybean oil, but the US market is being driven by domestic biofuel demand, creating a divergence in structure. So overall, last week's move need to be put into context. Palm oil weakness was driven mainly by macro and long liquidation, with the MPOB report confirming soft near-term fundamentals due to higher stocks and weaker demand. At the same time, production recovery is happening but remains gradual, and near-term demand is still very price-sensitive. On the other hand, soybean oil remains structurally supported. Strong biofuel demand, tightening stocks, and policy-driven consumption continues to underpin the market even in a weaker energy environment. Looking ahead, the market is likely to remain in a consolidation phase in the near term, but the longer-term direction, especially for palm oil, will increasingly depend on how the El Niño situation develops and whether it starts to impact supply into 2027. That's all from me for this week. Thanks for listening, and I'll catch you in the next update.
This podcast is for informational purposes only and is not a recommendation to trade, an investment research, or an offer to buy or sell any financial product. It does not take into account your particular investment objectives, financial situation, or needs. The trading of financial products such as futures, options, or swaps involves a substantial amount of risk and may not be suitable for everyone. Past results are not indicative of future performance. You are advised to perform an independent investigation of any transaction to determine whether any transaction is suitable for you.